Hello, my name is Keith Cooley. Today, I'm going to introduce you to budgets for community land trust properties. I spent 7 years at the San Francisco Community Land Trust as Director of Asset Management. I was responsible for the preparation of annual operating budgets and capital budgets for all of the properties in the SFCLT portfolio. I must have prepared hundreds of budgets for properties as small as a 3-unit building and as large as a 42-unit building. And this included residential and commercial units, both rental and limited equity housing cooperatives. Today, I'm going to cover why are budgets important, the different types of budgets, the general structure of a budget, how to prepare a budget, balancing the budget, and using it to monitor the income and expenses of the property during the year. And finally, I'm going to summarize some best practices and tips, as well as cover some mistakes to avoid. Okay, let's get started. What is a budget? I think we're all familiar with what budgets are. A budget is a plan for spending. It helps us understand where the income of the property goes. It's a tool for ensuring that there is sufficient income to pay for all the costs of operating the building during the year. So it's really important for asset management, property management. In addition, budgets provide some transparency of financial information for the CLT board, for the residents of the building, and for other stakeholders, such as lenders and city and county agencies. What are the different types of budgets? Well, I think one can categorize budgets based on their scope and the interval of time they apply to. The most common type of budget for CLTs is the annual operating budget for a property. This covers anticipated operating income and expenses in the next year. And today, I'm focusing on annual operating budgets for one or more properties. You might have heard the term pro forma used interchangeably with budget. Pro forma is derived from the Latin and literally means as a matter of form or formality. It's a term used in law, business, as well as finance. When used in real estate, a pro forma means a financial projection of rental income and expenses, highlighting what a rental property could, should, or would gross in revenue. It's a tool used to evaluate the risks of a possible acquisition of a property. Another type of budget is the capital budget. This outlines the expected major expenditure for the long-term care of the property. Typically, it covers a longer time period than an operating budget, 5 or 10 years, and it may be updated less frequently. It covers capital replacement and improvements of the property. One other type of budget that is important for CLTs is the cash budget. And this is for forecasting incoming and outgoing cash flow in the next 1 to 2 years. Let's look at the structure of an operating budget. Typically, it will consist of 2 parts. First, income, sometimes called revenue. For rental properties, this will be rent. For housing cooperatives, it is called a carrying charge. Other possible sources of income include renting garage space and storage space, or the fees from laundry machines, There can be other income. Secondly, expenses. These are the costs of operating the property. They will include property and asset management fees, legal costs, accounting costs, all the different utilities, property taxes, property and liability insurance, a whole host of maintenance and repair costs. Sometimes debt service, that is the monthly loan payments for the property, are broken out into a separate part of the budget. Typically, debt service is a fixed amount every month, unless you have a variable interest rate loan. Let's look briefly on how to prepare an operating budget. The process and timeline for budget preparation needs to be tailored to your specific situation. Before defining what that process is, you need to answer these questions. To what degree do you want to involve residents in the process? Do you want to involve the CLT board? Does the budget require board approval or review? The answers will have an impact on the process and its timeline. There could also be regulatory issues that affect that process. For example, in California, rent increases require a 30-day written notice to tenants. So that has to be put into the timeline. A budget is always based on past spending and income. In most cases, you can anticipate future costs and increases in income. You're going to need a current rent roll to determine the income, and this will have to be offset by a vacancy rate. What is realistic for your district. A helpful tool for preparation is a report comparing actual spending for the year to date with the budget for the year. A sharp variance from budget requires explanation. Spending on categories that are substantially higher than projected may require an immediate budget adjustment. Underspending or overspending needs to be explained to see whether it is an unusual occurrence or whether it's likely to be repeated during the period of the budget. Looking at expenses, in many cases, you can anticipate future costs. For example, utility companies provide advance notice of rate increases. In California, property taxes increases can be calculated based on the announced tax rate. Maintenance and repairs are often expensive with the most variability, and it's much more difficult to anticipate costs. For newly acquired properties, the seller is obligated as a part of the disclosure process to provide spending records of income and expenses over the past year. Okay, let's turn to balancing a budget. Clearly, income has to exceed expenses in a budget, but by how much? Lenders often require budgets to balance with a specific debt service coverage ratio. This is often shortened to DSCR. It's a measure of the net operating income from a property. A ratio of 1 or above indicates that income exceeds expenses and debt obligations. Lenders often require a ratio of 1.1 or above. It may be necessary to increase rents or to reduce expenses to balance the budget. Another possibility is to obtain an operating subsidy from a city or county source. Where the property is housing extremely low-income households, a subsidy will often be required. The question is whether you want a property financially sustainable and not dependent on annual government funding for its operation. It's all very well to prepare an operating budget, but to effectively use the budget as a tool, the spending and income for the property has to be monitored during the year and compared to the budget. Best practice is to have accounting produce a monthly profit and loss statement, often shortened to P&L, also known as an income and expense statement. This will include year-to-date numbers as well as a comparison against the annual budget. So, in summary, here's a few tips and mistakes to be aware of and the best practices. By and large, expenses increase at a faster rate than revenue. This needs to be factored into your budget preparation. I've already mentioned one of the most significant mistakes. That is preparing the budget and then ignoring it during the year. The goal must always be to have a realistic budget that reflects actual income and expenses. If it does not, then the utility of a budget as a tool is limited. Best practice is that every property has to have its own separate annual operating budget, and to involve stakeholders in the review of the draft budget, and in some cases, actually participate in the process. I've given an overview of why a budget is important and how to prepare and monitor a budget. We've skipped over a lot of detail about the income and the expenses that go into the budget. But I hope you find this video as a useful introduction to the annual operating budget for a CLT-owned property.